All right, everybody, welcome back in. In this video, we're going to be going over the four hyperscalers earnings reports from last week. We also had companies like Mastercard and Visa report earnings. We're going to talk a little bit about them. As you can see here in my portfolio, I am a Meta shareholder. This is my biggest individual stock. I'm also a Mastercard shareholder. This is my third biggest position. They're roughly about the same size position. I'm also a Google shareholder. And I have looked at Amazon and Microsoft for years now, so they're definitely on the radar. We're going to take a look at those earnings, and I'm going to tell you guys what I plan on doing with my Google shares going forward. As you can see here, let's take a quick look. Google is up 22% this year. Over the past 1 year, it's up 135%. This is not very natural for the second biggest company in the world to be up 135% in 1 year. I was buying shares last year in the 150s, 160s, 170s. I continued to buy it. I bought some shares around 250. I bought them under 200 or above 200. So I definitely built out this position last year, and I actually trimmed my position at the beginning of the year at about $340 per share, somewhere around here in February, beginning of February, end of January. I had 24 shares. I sold down to 17. I'm still sitting on 17 as we sit up here, close to $400 per share. I believe it hit close to 394, 395 at the highs. But let's just go over some quick numbers from the quarter here. The quarter was great, obviously. Revenues are down quarter over quarter, but Q4 is a banger quarter for the company historically. As you can see here, over the past 1 year, revenues are up 21.8%. That is massive growth for a company of this size. And if we break this down into their different business segments, it was spectacular as well. Google Search, this is their moneymaker. This is their high margins. This is the business that you want to see growing. Look at this acceleration. Over the past 5 years, it's grown at 13.6% per year. Past 2 years, 14%. And over the past 1 year, it grew 19.1%. So artificial intelligence is in fact helping this business. They came out and said that artificial intelligence is helping them monetize certain searches. So basically about 1/4 of their searches before artificial intelligence integration into the search platform, they were able to monetize with ads correctly. But now artificial intelligence is better targeting ads. They're getting more bang for their buck per advertisement from their advertisers, and they're wanting to do more business with Google search. So 19% growth year over year is spectacular for search. You look at YouTube ads, it's up 10.7% year over year. This is a slight acceleration as well. I'm sure artificial intelligence has something to do with targeted ads here. But keep in mind, YouTube is very already mature, and they have other revenue coming from YouTube through subscriptions. So you look at Google Network, this is a very small portion of their revenues. As you can see, this is down 4% year over year. I'm not too worried about that. Google subscriptions. This has to do with the Gemini subscription, the YouTube TV subscription, the YouTube Premium subscription, YouTube Music subscriptions. A lot of this is going to be YouTube Premium and YouTube TV. But this has grown at 19% year over year. They came out and said they had over 350 million subscribers across all their subscriptions at this point. That is a massive scale. So this is amazing growth. High revenues on the subscription revenue as well. And then lastly, Google Cloud. Well, mainly lastly, we also have Waymo we'll touch on. But Google Cloud is up 63% year over year. This chart just doesn't even look real. I mean, the amount of growth that all of the clouds are seeing right now is crazy, but Google Cloud really blew it out of the water. The street wanted around 50% year over year growth, which was already higher than AWS and Azure. But 63%, they kind of just went way over the top here. You can also see this in the backlog. It just looks fake. Look at this. This just doesn't look real. It's growing steadily, and then boom, boom. It's just two big legs up. 460 billion. They said over half of this revenue or this backlog will be seen as revenue within the next 2 years. So that's another 230 billion in revenue coming towards Google Cloud. And let's see, what was the number of this quarter? 20 billion. So you're going to see at least 230 billion from their backlog. This is just from their backlog, from their guarantees, from the deals that they've made coming their way. So we also had Waymo. They surpassed 500,000 weekly rides with Waymo. There is no second place at this point. Tesla's doing a little bit. There's some other small players doing some rides. It's mainly Waymo. Very, very, for a small bet, a portion of the company that doesn't really mean anything. Obviously, they're investing money into it, but you love to see this out of Waymo. They are really scaling. They're taking the lead even further. And then look at the EPS. Part of this is investment gains. I don't want people to think, oh, look, Google's only trading at a 29 price to earnings still. This is a big jump. The street wanted about $3. So this almost doubled it due to, they actually beat earnings per share just off of their operating income. But they did have some investment gains that really boosted up this earnings per share. So that's why the forward multiple is higher than the trailing multiple, which is usually the other way around. As you can see here, the 2-year forward multiple is the lowest one because they're going to outrun that eventually. Just one quick second here. Operating margins for Google Cloud went up almost another 3% quarter over quarter. Very impressive. So yeah, and that's kind of my concern with Google. You see here, I don't know if this number is correct here. I believe they didn't buy back any shares in this quarter, so I'm not sure what this 15 billion is being displayed on Qualtrim. I'll have to double check that. Which I kind of like the fact they're having to spend all of this capex. They upped capex again, but they're saying, the Wall Street is loving it because they're seeing all of these revenues come in immediately through AWS and through Google Search, accelerating. So they're seeing it pay off. So they're kind of fine with the spend from Google, but it is very expensive on the cash flow. As you can see, the cash flow is just kind of flat here. I mean, there's some growth. Over the past 2 years, it's up 6% per year. There's some growth, but comparing that to the revenue or the earnings per share, yeah, I mean, it's just not even the same. All of that's going to CapEx. But they are still free cash flow positive. You can see free cash flow per share. Let's do this on a trailing 12-month here. Over the past 4 quarters, the free cash flow per share is sitting at $6 per share. So not bad considering they're investing so heavily. But what I wanted to say is the stock is getting hot. I love the company. I don't want to trim my position anymore. But, it's getting a little too far ahead of itself. Let's do a DCF here. Or sorry, one thing. Let's pull up the operating cash flow of the company here. Let's pull this up for fun. Operating cash flow. All right. And then, actually, I think I can pull this up on per share. Operating cash flow per share. I believe that's in here. Yes, I love this feature. Okay. And then we will layer this with price to operating cash flow. Maybe I have to type it out. Price to cash flow. Price to operating cash flow. Okay, here we go. All right, let's zoom this out to 10 years. We're going to do this on a trailing 12-month basis. And you can just see it here. Let's maybe change these colors. Yeah, we can see this better with the red. Okay, but you can see the price to operating cash flow has been sitting around, 18, 20. It gets up to a high here in 2021 when the whole market overheated to 24. It goes down here to 12 in 2023. 2025, when I was buying heavily, it's at 13. In between, it hit peaks around 22, 20. But right now, it's at almost 30. This is just so far ahead of anything we've seen in the past decade. So it's at 24 at its ultimate peak before this run up. This is up to 29x price to operating cash flow. Yes, it's growing fast. Let's hide this. Price to operating cash flow. Operating cash flow over the past 10 years is up 540%. Show me a compound annual growth rate. There we go. It's compounded at 21% per year. And if you don't know, price to operating cash flow, this is the cash flows that they're getting and retaining before capital expenditures. So if they stopped all of this CapEx build out through Google Cloud and they're all of their data center capital expenditures, we would see all of this free cash flow. Not all of it. They would obviously have to invest some back into the business, but a lot of it would be going back to shareholders via dividends, buybacks, or investing into something else, or just boosting up the balance sheet with more cash. Either way. But, it's growing at 21% per year. It's at a 29, almost a 30 multiple. So let's do this. Let's say they trade at a free cash flow multiple of Oh, I already pulled these numbers in before I started the video. Um, but let's say they're at the, the 1362. This is the operating cash flow. Um, and operating cash flow, we'll say it grows at 20%. It's growing at 21%. And let's say it trades at a 25 free cash flow multiple. They would have to hit, constant home runs and trade at the ultimate peak of their price to operating free cash flow, which was at 25, other than right now. So if they were to trade down to a regular multiple, stop giving me pop-ups. If it was to trade down to a regular multiple, I think the average was somewhere around 18 to 20 for Google there for their price to operating cash flow. And, I'm not going to shoot for the stars. They've grown at 21%. They're a much bigger company than they are, now than they were 10 years ago. We saw it grow at 21% over the past decade. Let's say it grows at, 15%. If we get that 15% growth in operating cash flow and it trades at a 20 price to operating cash flow, we're only seeing 7% returns. So what I have done with my Google shares is I have 17 shares still. I had 24. I have an order. I know the company. I honestly think it's probably going to run a little bit more here. But I set an order to sell one of my shares at $3.95. I set another order to share another share at $4.10. And I set another order to sell a third share at $4.25. So if we run up to $4.25, we're going to be closer to like a 32 price to operating cash flow, which is so expensive for Google on a trailing basis. I do expect the company to grow, that 15 to 20% per year long term, which is a exceptional growth. If they grew it at 12%, that would still be great growth. 10% is not bad. But with the pricing, you need them to grow at 20% per year for the next decade, which is just very hard to do at this size. Like I said, they're the company with the most net income of any company in the world. They're the second biggest market cap in the world. Only a few percentage points behind taking over Nvidia for, the biggest company in the world. The valuation is now close to $5 trillion. So that's my thoughts on Google. It was a great quarter. It truly was. The Google search revenue and the Google Cloud revenue was just astronomical. It was great. You saw, I kind of scanned through these while I was talking, but you see the return on capital is at 30%. The gross margins, they're up at 62%. Operating margin for the quarter, it's at 36%. Profit margin, I don't know if this is right. It might be. But yeah, it says 56%. This just looks like a complete outlier. Maybe it is correct. Needless to say, it was higher than it was last quarter. I know that. And the balance sheet still has more cash than debt. So, like I said, great quarter. I am going to take a slight trim if it continues to run up. We're like 2%, 3% off of that $3.95 for my first share. And I just see a lot of different opportunities. As you can see my portfolio here, a lot of these positions I started, second half of last year or this year. Adobe, crushed. I started the position. I'm down like 25% on it. I've put $10,000 into the company. Meta, I'm basically flat. I'm down like 5% at this point. This company sold off hard after earnings. We're about to take a look at that. I think this is still a screaming opportunity. Mastercard, I started this position last year. They had great earnings. Visa just kind of one-upped them on this one quarter. So Visa kind of ran up. Mastercard kind of ran down. I'm down again about 4 or 5% on this holding. I would love to add to this company. We will take a look at those earnings. S&P Global, we went over those earnings in the last video. They were great. I'm down a couple percentage points on S&P Global at this point. Duolingo, I'm actually very, very bullish on this company. I don't know what's going to happen in this next quarter. They report earnings on, I believe, Monday. But I'm down like 35% on this holding, so I would love to add to Duolingo. These are all great opportunities to me. Intuit, I started that position this year. I'm roughly flat. PayPal, I've held this company for 2 years. This is one of the two companies I'm thinking about selling out of completely, PayPal and Robinhood. I almost sold out of some of my Robinhood shares at 95. It got up to 93.50. Now it's down back to like 70 something bucks. Their earnings report wasn't great. Needless to say, all of these opportunities to me are really good buying opportunities. I love Copart. I've had a couple videos on Copart. If you want to check those out, go ahead. I think Toast is a great opportunity. Uber's a great opportunity. Spotify is an amazing opportunity. I started that position this year. I've wanted to own this company for years. So the market is really selling off a lot of high quality companies that I've been following for a long time now. And Google's just kind of overheating. So that's my plan with my Google shares. Let's take a look at Meta. This is the next, CapEx beast that reported earnings. It was a great report. It really was. Um, Revenue is up 33% year over year. I thought Google's was impressive at the 21%, I believe they did. This destroys 21%. 33% is insane. This is acceleration. Over the past 5 years, it's up 16% per year. Over the past 2 years, they're up 24% per year. They grew at 33% per year. A couple other KPIs that I love to look at. This is one of the concerns. The management did give us a reason here. This is the first time in years that family daily active people has dropped, although it was very small, 3.58 billion to 3.56 billion. And Q1 is one of their weakest quarters. People are very active on social media during the holidays and stuff. But needless to say, it has gone up nonstop, for years now. But they did say their users saw a lot of internet outages in Iran. Iran is a big country. They have hundreds of millions of people there. I believe the population is close to 100 million people. Don't quote me on that. But also, WhatsApp was sort of blocked in some areas of Russia, is what management said. So WhatsApp is very popular. If you're outside of the United States, which I know a lot of my viewers are in the United States, you don't use iMessage, you use WhatsApp. That's what you use. So Russia's a very big country, so if that's blocked, that makes sense why they had a small drop here. Other KPIs that looked amazing. Average revenue per user. This is what I was focused on. I made a video, what I wanted to look at going into these earnings. This was the one thing that I wanted to see. I was looking for 15% year over year growth in this KPI here. That's what we've seen over the past 5 years. I thought maybe growth would slow a little bit. But this is kind of them, pulling the lever on their massive user base for monetization. This grew at 27% year over year. Average revenue per user this quarter last year was $12.36. It's now over $15. It's at $15.66 in average revenue per user. Absolutely insane. Whenever your user base is in the billions, it's half of the world. You get $15 per user. That's just absolutely incredible. The EBITDA looks good here. Net income looks great. I went over this in a couple videos in the past. This one quarter, Q3, was a one-time tax hit. It was massive. But the net income over the past year is up 61% year over year. I do believe they had some accounting one-offs here, so it might have been closer to 55%. Purely, if it was just the numbers of the operating business. Free cash flow, it's getting eaten up with CapEx. It still grew 19% year over year. Over the past decade, it's still grown at 22% year over year. On a per share basis, it's about the same. But I do believe they stopped buybacks this quarter. It's just they did some. Okay, so they did some buybacks. They didn't do any in Q4. And I think this is great. They did have a debt offering because they are spending so heavily. As you can see here, the cash to debt, it's still more cash than debt, or cash and cash equivalents than debt on the balance sheet. So they're still sitting pretty. You have everything just up and to the right. The revenue, this is the second fastest revenue of any big tech company other than Nvidia at this point, which Nvidia is people are still trying to figure out what the future of that company holds. How long will this AI build out go? How long will they hold first place? Meta is an extremely wide moat business. If I gave Apple, $500 billion and I said, hey, go replicate Meta, good luck, buddy. It's not going to happen. The company, let's look at a couple of the ratios here. Return on capital employed. This is going down because they're investing so much, and it's still at 26%. A quality business is really anywhere above 10, 15%. This crushes that. Gross margins, 82% on half of the world. That's incredible. Operating margin, 41%. Profit margin, 47%. So the one thing that was, that scared Wall Street out of this company for this earnings report was the capital expenditures went up. They said it's going to go up another 5 to 10 billion. And it wasn't, that they think they need to invest more. The problem was this was just incremental cost, on storage and memory. They said the costs were a lot more than what they expected. So that's good for Micron or other companies that they're buying stuff from. But this is not great for Meta. That's basically they're losing another 5 to 10 billion dollars this year just due to prices going up on them. Obviously, that is a big hit. But they have the cash on the balance sheet to pay for that 5 to 10 billion dollar difference. They have the cash flows coming in. We'll take a look at the operating cash flow here shortly on the charts, but really quick, let's look at the price to earnings here. It's at a 22 at this point. The company's down 6% year to date. Over the past year, it's basically flat. So you've seen this, revenue's up 33%, stock price is flat. Earnings per share is up 62%. The share price is flat. So, and if you look at the free cash flow yield, they're spending so much on capital expenditures, and before dilution, it's still at 3.13% free cash flow yield. So the company is cheap, in my opinion. But yeah, 22 price to earnings on a trailing 12-month basis. And keep in mind that has this one quarter in it. This would be closer to like 19, 18, 20, something like that. If this one-time tax hit, which was a truly one-time tax hit from the big beautiful bill, if you take that out, the company's trading at like a 20 price to earnings. Historically, that's super cheap. Let's zoom out here to 10 years price to earnings. It dipped in 2022. I wish I was buying this company then. I was buying a lot of index funds in 2022. Needless to say, I did great on those investments. But earnings dropped, and the price of the shares just got ridiculously cheap. It traded down to a 10. But you see it trades up to 35. It trades up to 33. It trades up to a 32. It trades down here at the bottom last year. It traded down to a 20. So, I mean, you go further back, it's at a 34. It's at a 40. It's at, 2018 bottom. It's at a 20. It's at a 19. So right now we're at a historical bottom, other than the one-off in 2022 when earnings fell and the market sold off like crazy. So it could get cheaper long term. I think it's going to continue to compound. We saw the growth. Let's look at let's pull up the charts on it here. Let's do Meta. And we will do price to operating cash flow as well. Price to operating cash flow, we'll lay this over. So the operating cash flow over the last decade, you saw the Google number. This is like double. It's up 1,100%, almost 1,200. And the price is cheap. Yet again, you see the 2022 price to operating cash flow, it's down to like a 5 at the bottom. But it gets up here, price to operating cash flow 26. Back here 10 years ago, 34. Right now, it's sitting at 13, 11, 12, somewhere around there, depending on the day. This stock has moved a lot this year, as you can see here by this chart. But I do think it's cheap. I think the company's in a great position long term. I think AI is going to help this company, maybe the most out of the Mag 7 companies long term in terms of profits. So I think it's a buy. 12, 13x price to operating free cash flow, and it's growing at, here, let's see. Give me a compound. It's growing at a 30% clip per year over the past decade. It's incredible. The growth is incredible. Let's do a DCF on Meta. We'll just do it on earnings. We'll keep it simple. Like I said, I already pulled in. This is what the earnings per share would be over the past year if it wasn't for that one-time tax hit. So we're looking at 33.30. If this grows at only 20%, like I said, it grew 60% over the past 1 year. It's grown at like 30% over the past decade per year. So 20% is a massive deceleration. It trades at a market, not a market multiple. Market multiple is about 16, but those companies grow at 5% per year. This company's growing at 20. We give it a 25 multiple, premium business, one of the widest moats in the world, fast growth. This is extremely, extremely, extremely doable for Meta. You're getting 28% returns. So that's why I'm willing to pivot from Google to Meta. I think they're both great companies, two of my favorite holdings. One outran itself, one is lagging. I'm down to pivot, a little bit of my allocation into Google into Meta. So really quickly, let's take a look at Mastercard. That's my last holding that reported. Like I said, we'll talk a little bit about Amazon and Microsoft as well. I didn't hold those. I do hold Mastercard. So year over year, revenues grew 16%. Visa's grew, I believe, 17%. So the market was like, oh, Mastercard grows faster. We're going to get 18% growth. They still beat numbers here. They beat on revenue. They beat on earnings per share. But I think investors really thought they would outpace Visa, as they usually do. Remember, this is one quarter. If Visa beat Mastercard on one of these quarters, you wouldn't even remember at this point because the company compounds so well. Mastercard has already been pulling their levers on value-added services, where Visa finally just started. That grew about 40% for Visa, and you can see here value-added services. It grew 22% for Mastercard, which is exceptional, but that 40% for Visa in one quarter really boosted their numbers. So you can see the value-added services is growing in the low to mid 20s. And the payment network, this is like the old, slow-moving, stodgy business. This is growing over 10%, 11% year over year. Very fast growth. The total number of cards went up another 200 million in this quarter. Sorry, that's 20 million. 20 million in this quarter, up 6.5% year over year. Very fast growth. Earnings per share, 21% over the past year. Free cash flow, 28% year over year. 31% on a per share basis. This is spectacular growth here. Over the past decade, free cash flow per share is going at 14%. Let's do this on a trailing 12-month basis. This might be even better. Look at that. 19.3% over the past 10 years per year growth. This is what this company does. They continue to compound. They have a capital light business model. You can see that here in the ratios. Return on capital employed is 67%. That's incredible. Gross margins, 75%. Operating margins, 58%. Profit margins, 46%. So they do that, and then this is what they do. Look. Quarterly, look at the return of capital. Whenever the stock sells off, they buy more shares. Whenever the stock heats up, they ramp up the dividend. That's perfect capital allocation. They always ramp up the dividend a little bit, and buying back shares also ramps up the dividend per share. But you see, common stocks repurchased over the past year. They bought back 50% more shares than they did a year ago. Like I said, actually, I haven't looked at the price chart here on this video, but down 12% past year to date, down 12% over the past year. So the company's a lot cheaper, especially considering the earnings per share is up 21% year over year. So the management is smart. This is one of the most important things that management can do is allocate capital, especially when they have a bulletproof business model laid out in front of them already. You see they have a little bit of debt. This company is so reliable. They're going to print free cash flow. They can pay this off in like 2 years. Shares outstanding. You love to see this. They've bought back 2% per year, every year for the past decade. They're sitting at 893. We'll call it 900 million shares now at Q1 2026. Q1 2016, where are we at? 1.1 billion. So they've bought back, 200 something million shares from 1.1 billion. The company's cheap. This company is so high quality. Look at the free cash flow yield. After dilution, it's at a 4. DCF here. Okay, here we go. Mastercard. We'll do it on cash flow. These are some numbers I had put in already. We'll do a yield. Okay. Free cash flow growth over the last decade has grown at 20%. They have value-added services lever to pull now. I think this might grow faster. We'll say it's even slower, though, just to be safe. 18%. The company's at a 4 yield now. Historically, it trades under a 3. So we'll just be safe. We'll put it at 3.5. It gets a little bit more expensive. This is still very cheap for Mastercard. I'd buy it at a 3% yield. You get 20% returns here. I'm very happy to buy Mastercard. Like I said, I think they could do more than 20%. They could do 22%, and they could trade at a 3 yield. That just gives you almost 30% compound annual growth rate per year. This is a great buy. Let's take a quick look at Microsoft. Here, I wasn't impressed by this earnings report, mainly due to the cloud. They are I believe the second biggest cloud behind AWS. So they have a lot of room to grow still, kind of like Google does. It grew fast. Don't get me wrong. Do I have this on? Yes, I do. Don't get me wrong, it grew fast, but this is less than half of Google's growth. And they don't have the OpenAI, individual partnership now. You could only use OpenAI on their cloud until recently. Now it's in Amazon's cloud. So they don't have like a differentiator. They don't have their own model like Gemini. They have their own chips, but they're not nearly as advanced as Google and Amazon's TPU. So I think this is the inferior cloud out of the 3. In terms of total revenue, it grew at 18.3% year over year. That's great, honestly. Like I said, a lot of that's coming from cloud, but let's look at, this is basically their Office suite, all of their offerings. Dang, it doesn't give me a percentage. Oh well, it grew pretty fast year over year, 35 billion from 29 billion. I'm not sure the number on that, maybe close to 20%. That's what it sounds like. 365 consumer subscribers, up 8% year over year. So Claude and all that's not getting rid of seats yet. I really don't know if it ever will, but Claude, whatever, all the AI models, they're not getting rid of the seats yet. 8% growth year over year. For a, this is almost a saturated market, I would say, for Office 365. Return of capital, they still are free cash flow positive, so that's good to see. They're allowed to buy back some of these cheap shares and pay their dividend. Their dividend eats up a lot, so they're not buying back a lot of shares here, but earnings per share, where's that at? Here we go. Earnings per share is up 23% year over year. That's great. Considering I don't think they bought back that many shares. They only bought back 0.2% of the float. So that's just net income is up 23%. We should see that here. 23%. So solid quarter. The backlog is barely up at all, but they had this big jump last quarter. I think this was one big, commitment from OpenAI last quarter, which is kind of what did the sell off. Year to date, they're down 12%. Over the past year, they're down 5%. So this has been a laggard. It's decently cheap, but I'm not as confident with this company. I think Excel does face some of the problems that a company like Adobe does, with some seat dilution problems with their software. And I do think that they have the inferior of the three clouds, and it's at a 25 trailing multiple, 22 forward. I would much rather buy Meta. I think I'd rather hold Google at current prices than Microsoft. I'm just not as sold on this business compared to the others in terms of future growth. I think they might have some struggles with the Office suite, and the cloud business isn't my, main thesis on Google, but I do think theirs is much better. I think Amazon's is much better. Now let's go to Amazon. This was a banger quarter from what I remember. Revenue. Remember, this company does the most revenue of any company in the world. It grew at 16%, 16.6% year over year. This company's rallying this year, as you can see. Past year, 44% year to date, close to 20%. But per segment, this is kind of like a Google. This one's just so diverse. AWS up 28%. Remember, this is the bigger cloud. It's almost as big as the other two combined. So obviously, it makes sense for them to be growing slower. Still very fast growth. We'll take a look at all of them. Subscriptions is up 14.6%. That's great. Advertising. This is another big growth driver for the company. I'm very bullish on this segment. This is probably my favorite segment, other than just the delivery service. Just the what's the word for that? What Amazon does, e-commerce business. That's probably my most bullish because they have so much revenue from it, and I think robotics and a couple other things are going to drive just a little bit of incremental margin expansion. I think that's probably my favorite business segment from Amazon. This is a very diverse business. That's kind of why I don't own it. I do like the company. Third-party sellers, this is small, up 13%. Physical stores, this is just Whole Foods, it's up 5%, sure. And first-party online sales is up 12%, so this is their own, their products up 12%. So very impressive. Look at this. Their RPO is up a lot. I mean, it almost doubled here. It went up like 50% here, 40%. Quarter over quarter, not year over year. AWS year over year growth. We already saw that. AWS operating margin continuing to climb up here. Not quite at its height from Q1 2025, but it's still way up there. They do have Zoox. They reported that Zoox is starting to, scale out. It's going to be in a couple new cities. I believe it was Vegas and another one. I don't remember. Maybe they're already in Vegas. But they're working on Zoox. I think that technology could be, something that they integrate into their e-commerce business. To self-drive vans, they pay a lot of drivers. So we'll see how that plays out long term. Net income's up 76% year over year. This chart just looks silly and dumb, which it is. Free cash flow, this company, they hate free cash flow. They hate giving money back to the shareholders. Not really. They just love investing in profitable businesses. Minus 18 billion in free cash flow this quarter. But the earnings per share, like I said, way up. So I think long term, the free cash flow will eventually come in one day. But them investing into the growth is very, very beneficial for shareholders and for the business itself. Return on capital, it's decent, about 15%. Gross margins, 51%. Look at this climb, just steady. Operating margins, pretty much the highest it's ever been, 13% here. Profit margin, 16%. So impressive quarter. I believe they said they're ramping up CapEx as well, that or they held the same. But the market is seeing AWS excel. So they're giving them the pass. I do think the company was a little undervalued. This company's growing so fast in terms of earnings. and it's at a 31 trailing, 28 2-year forward. It's not near as cheap to me as Meta. I do think it's a good buy. I think if you wanted to sell out of Google and buy Amazon, that could be a play. Even though Amazon is hot, it's not. It's nothing compared to Google. This 43% is nothing compared to that 130%. So yeah, that's basically all I've got on these companies. I do think a lot of them are a buy. I think Google will do fine long term, guys. I don't want you to think I'm bearish on Google. I just think it's getting a little ahead of itself. It could end up looking like Amazon's 5-year chart. Really, is what this could turn into if we see it run into the 400s. Past 5 years, it's only up 58%, and all of that is over the past 1 year almost. So I'm a little skeptical of that from Google. They're kind of just outrunning what's really gonna, compound for the business internally in terms of intrinsic value. So that's why I just wanted to let you guys know that's why I'm thinking about trimming. I've made a lot of money in Google, $3,400, and that's not counting my gains from the 7 shares I took. This is probably close to $5,000. And as you can see, a lot of these other companies are selling off. I do want to take a look at this, Adobe. Like I said, I see a lot of the same fears with Adobe and Microsoft, in my personal opinion. I think Adobe might be even more sticky. I think it's easier to replicate, accountants and things like that than a physical, something that's visual for a human. Look at this valuation. 10 forward PE, 14 trailing PE, 10% free cash flow yield. There is no hiccups in the fundamentals on Adobe. So that's why I would like to buy something like Adobe much more than a Microsoft. But that's all I've got for today. Let me know what you guys thought of this earnings week. We have another big one coming up. Actually, let's look at that really quick. Earnings watch list. Here we go. I'll be making some videos next week, hopefully. We got Duolingo Monday, PayPal Tuesday, Ferrari. I'll check that one out eventually. I don't hold it, but I have watched it. Uber on Wednesday, new holding. Airbnb, I love this company. Zoetis, I've been checking this one out a little bit. I like Airbnb a lot. And Toast, I hold Toast. I think I'm really, excited for all of these. PayPal is probably the most interesting one. Duolingo is also very interesting, but PayPal new CEO, we get to see what they're gonna, there's rumors of a buyout, whatever. So PayPal is gonna be very, very interesting. Duolingo, this stock has been hammered, so we'll see. I'll talk about these earnings next week. Let me know what you guys are excited for this coming up week and what you thought of the earnings week last week with all of the Mag 7 reporting almost. And y'all have a great rest of your day. Thanks for watching.